Good evening. Thank you very much for joining us tonight. And skipping the Olympics, we're very pleased. We actually think .con will be more interesting than the opening ceremonies. John Cassidy has written an extremely interesting book, for those of you who have not read it yet, about the rise of the internet bubble and the burst of the internet bubble. For those of you whose bubbles burst, I apologize, but possibly he can give you some insights. Please join me in welcoming John Cassidy.
Good evening, folks. Thanks very much indeed for coming out, especially on the first day of the Olympics. Delighted to be in Silicon Valley, the home of esteemed internet companies like Webvan, At Home. See a couple of cheers there for Webvan. Webvan, At Home. And my personal favorite, I think, AskJeeves.com, which reported this morning some excellent profits. I think my all-time favorite internet company, Silicon Valley internet company, was one which didn't actually make it to the IPO starting line, but which I found out about when I was researching this book, and that was funerals.com. I don't know if any of you heard that one. Yeah, it was one of the Silicon Valley venture capitalists tells a story about it. He went to meet, in the old days, you know, when money was growing on trees around here, and anybody could, you know, call up and say, I've got a bright idea, will you give me $5 million to back it? Bright young guy arranged to meet one of the Silicon Valley, you know, VCs up in Menlo Park at one of the famous coffee shops where you went to raise the money. And he was introduced, you know, and sat down and said, okay, kid, what's the pitch? And the kid said, funerals. Going to take funerals online. And the guy said, funerals? That sounds a bit of a downer, don't you think? I mean, how are we going to get people excited about funerals? The guy said, yeah, it was a bit of a downer, but, you know, I want to put the fun back into funerals. We're going to make it a real interactive experience, you know. Okay, you're still going to have to bury the guy, and that is a downer, but everything else about it we can take online, you know, choosing the casket. The guy said, oh, Silicon Valley guy said, I've backed a few, you know, dodgy companies in my time, but I don't think I can back that one. And he passed him on to some of his friends. And the young entrepreneur actually did get as far as raising, I think he raised $100,000 seed capital, but the bubble burst before he managed to take funerals.com to the NASDAQ. So we don't have an online funerals billionaire, unfortunately. But maybe we would have done if things had lasted beyond April 2000. Anyway, obviously that's an extreme example. The book is not all about trivial examples, and I by no means intend to say that all internet companies were as trivial as funerals.com. But I think it was just a good example of how crazy things got by the end of the bubble. My book, .con, is an attempt, it's really a history book. There's been a lot of books written about the internet and about individual companies. You know, if you walk around this Barnes & Noble superstore, you can probably pick up books on most of the big internet companies, Amazon.com, America Online. As I say, most of them have had books written about them. There have been books written on day trading. There have been lots of books, obviously, written on the technology. There's a whole section devoted to, you know, internet software, etc. But nobody had really pulled it all together in a history book. And that's what I tried to do. And it's really sort of I'm not a technologist. I don't pretend to be a computer expert. I'm trained in journalism as a reporter, and I've done some history and I've done some economics. So my book is an attempt to place the internet boom in historic perspective and to try and explain where it came from, how it was possible that, you know, some guy could even think about floating funerals.com, and how, you know, Webvan could go public, a company like that. How did things get to that extreme? And I'd start way back in, you know, I take it from the beginning of the development of the whole idea of digital technology back in the 40s and 50s. But the real start of the internet bubble, which is the second, where the narrative for the book really begins, was of course the Netscape IPO in August 1995. I actually started work at the New Yorker magazine in September 1995, having previously worked as a newspaperman at the London Times and the New York Post. So I was hired at the New Yorker to cover, you know, the economy and American business, And suddenly, you know, as soon as I arrived there, this astonishing story started happening, the development of the internet boom. So I covered it on and off for, well, mostly on, for the next 5 or 6 years. And this book really grew out of my reporting. I wrote stories about not most, but a good few of the internet companies individually. I also wrote a couple of big stories about how Wall Street promotes internet stock, how the investment banking business works, the role of venture capitalists, etc. And I also covered the Fed, Alan Greenspan. One of the aspects of this book, which I think probably separates it from other accounts you may have read, is that I make great play of the role played by the Federal Reserve in pumping up the bubble by following low interest rate policy for so many years. Greenspan did make the famous speech about irrational exuberance back in 1996, December 96, for which he's famous. But he didn't actually do anything. You know, Wall Street just shrugged that off. It would have taken a sharp rise in interest rates to burst the bubble, and he wasn't willing to do that for reasons I explained in the book. So anyway, it's really a narrative, the book. It starts with the Netscape boom, with the Netscape IPO rather, and I mean, it's hard to think now, but it is nearly 7 years ago since the Netscape IPO, which I guess in internet years, they used to say it was 10 years for each, 10 internet years for each regular year, so it's 70 years ago in internet time. Some of the internet guys probably feel 70 years old after the last 7 years. But anyway, I think the Netscape, all speculative bubbles, this is really the story of speculative bubbles. All speculative bubbles take place in several stages, 4 stages really. There's something which starts it off, some big displacement. In this case, it was the invention of the internet, the growth of a stock market culture. Americans were already getting used to the stock market through 401ks and mutual funds, which had grown up in the 1980s. Another important factor, I think, was the end of the Cold War, and the general idea that, you know, history, as we understood it in the post-war era with the East versus West confrontation sort of defining things, that was all over. You know, obviously the Berlin Wall came down in 1989. People were looking around for some big new narrative. What was next? Where did mankind go next? And the internet seemed to answer that, you know, because the answer was, well, we go into cyberspace. And here was this revolutionary new technology, the internet, which seemed to break down ethnic rivalries. It was a global thing. It seemed to break down geographic boundaries. Distance didn't mean anything. Once you logged onto the internet, it didn't matter where you were, whether you were in Lagos or Lima or wherever the hell you were, you know. Distance was of no consequence. And that was a very potent image and ideology, actually, I think, eventually. And it also especially appealed to Americans, I think, because this was, after all, an American technology. The Pentagon invented the internet. They came up with the technology. It's often seen as a great capitalist triumph, the internet, but of course it was a government. It was funded by the government. It was developed by the government. Private enterprise had no interest in the internet until it got up and running, until millions of people were using it. Private enterprise would never invest in something as risky as the internet. And, you know, even the early days, they used to look down on it, and what the private sector was interested in was the so-called information superhighway, which you may remember, long lamented. Anyway, so to cut a long story short, I think all those factors, you know, provided the basis for a big new movement, and the internet itself then became the focus of it. And then you had the Netscape offering, and you moved into the second stage of the bubble, which was the boom itself. And that lasted really from about August 95 until, in my estimation, the end of 1998. And in that period, that was when people started to, you know, the general public started to get involved in the internet. When it first started, you'll remember, maybe people around here in Silicon Valley knew all about it, but most people in America, it was, you know, a new word to them, internet, logging on, going online. It was a whole new vocabulary they had to learn. And they did learn it in these 3 years. Wall Street and the media played the principal roles in educating people about the internet. And I think it was in this stage, in the boom period, when companies like Yahoo and Amazon.com, At Home, you know the names better than I do. There were about 1 or 2 IPOs a week in those days. It wasn't as crazy as it got later on. But most of the big internet companies which survived went public in the 95 to 98 period. And as I say, that was when Wall Street realized that this wasn't just a small technology. It wasn't, in the old days, Silicon Valley was seen as a backwater in American finance. I mean, I report on Wall Street. I live in New York. And let me tell you, back in the early 90s, the big investment banks on Wall Street weren't looking to Silicon Valley for their money. If you looked at the financial markets in San Francisco, they were dominated by small firms like Hambrecht and Quist and Robertson Stevens. It was only when the internet came around, really, that the big banks like Goldman and Merrill and Morgan Stanley started opening offices here and exploiting the internet. So I explain all that in the book, how, there's several legs. The internet is like a stool, or the internet bubble, rather. The internet is, of course, the internet, of course, is like the internet, but the internet bubble is like like a stool of, I think, 4 legs. You have the technologists and the entrepreneurs out here. You have Wall Street, who supplied the capital. Well, the venture capitalists supplied the capital. Wall Street supplied the public to buy it. That's the second leg of the stool. The third leg is the media, who pumped air into the bubble and educated the populace about it. And then the fourth leg is the government, the Federal Reserve. Without any of those legs, it would the stool would have collapsed. You needed all 4 of them for things to get as out of hand as they did. So you had the boom period from 95 to 98. And then you have the crazy period, euphoria, whatever you want to call it, which it's, none of these things are fixed in stone, but I date it from October, November 1988, when you had, I think, the most famous one of all was the Globe.com when it went public. The 2 guys from Cornell who founded it in their dorm room, and it went public. I'm not sure of the exact figures. I think first day trading, it went from 12 to 72 or something, and these guys were, went from penury to not billionairedom, but multi-millionairedom overnight. Once that happened, there was also other ones like the Broadcast.com, but I think the Globe.com was the sort of defining moment. Once the Globe.com was worth hundreds of millions of dollars, anything could be worth hundreds of millions of dollars. They didn't have any revenues. The whole point of the Globe.com was they'd web host for you for nothing, and you could, set up your own home site. So there was no revenue stream. Of course, their idea was that eventually, somehow, there'd be advertising revenue, but never made any sense, because advertising, needs a mass market, and the whole point of the Globe.com was a bunch of individual sites where you went to look at your friend's website. So anyway, once the Globe.com went public, I think anything went, and we had euphoria, madness, whatever you want to call it, from November 1998 until about April 2000, and that was when things like Ask Jeeves and Webvan and another one of my personal favorites, Pets.com, went public. And by the end, by the end of 99, start of 2000, if you look back, there was often 6 or 7 or 8 IPOs, internet IPOs a day. Things had got completely out of hand. A lot of these companies were not even real companies in my estimation. What had happened, I think, by that stage, is that the normal sort of process of capitalism and American business had been turned on its head. In the normal process, in everyday capitalism, the way it works is that you have businesses like this one, who sell things to people who want to buy them. And the stock market is the sort of handmaiden of business. The role of the stock market is to raise capital for businessmen so that they can finance proper investment projects. So, the important thing is the business, the secondary thing is the stock. The stock is there to support the business. What happened in the internet boom is that model was turned on its head. The businesses were there to support the stock. The whole point of the exercise during the internet boom wasn't to create a business, it was to create a stock which you could then sell on Wall Street, persuade investors to buy. It would go up, the venture capitalists would cash in, the early investors would cash in, and everybody would get rich, except, of course, whoever ended up holding the stock at the end when it collapsed. But, most of the insiders didn't plan to be around by then. So, as I say, the internet bubble had its own internal logic, which it was capitalism gone mad. As I say, the stock market was the thing. The businesses were just secondary. Nobody bothered looking at revenues. A business has revenues and costs, and if the revenues are more than the costs, then perhaps it might be a good business. In the internet bubble, something as simple as that, just went out the window. And it's how you have to ask yourself. It's at the time, I was asking, lots of people were asking, but How can people be persuaded to buy that sort of a company? And my only explanation is that people stopped thinking of individuals. What crowd mentality took over. You know, people behave differently in crowds than they do as individuals. I can't believe that anybody sat in a room by himself would have bought a lot of these internet stocks, you know, AskJeeves.com or whichever, nearly all the late ones. It was plain insanity. If you looked at the actual business, they had no revenues, they had no business. The phrase people used was business model. You know, they had an internet business model. Well, the phrase internet business model meant that they didn't have a business. You know, it was the business model was raising money on Wall Street and spending it and hoping that at some indefinite point down the pike, revenues would turn up from somewhere, from advertising or from e-commerce or whatever. But you know, so that. How does that make sense? The reason it made sense was because people saw everybody else buying internet stocks and making money. I have a quote in my book from a famous economist saying, you know, there's nothing more damaging to the health of people's brains than seeing their best friends get rich and them staying poor. And I think that's what happened here, you know. All over America, people who prided themselves on being sensible American citizens, they looked around and they saw people who they thought were less smart than them and less experienced than them suddenly making a lot of money. And they thought, maybe I'm crazy after all. For the first couple of years they said, this internet stuff, I'm not getting involved. I mean, it's great, Amazon.com, Yahoo, give me a break. I'm not buying those companies. I'm going to keep my money in, you know, IBM or whatever, if they were technology, or, you know, Ford, whatever. But then suddenly their daughter's lazy boyfriend who laid around all day and did nothing and just played on the internet, he'd made $100,000 on his AOL stock. That sort of thing, you know, is very damaging to the national psyche. Everybody else says, well, you know, it's easy money. And you felt stupid if you were left out. You didn't only feel stupid, you then felt left out. And, you know, you were a dinosaur if you didn't understand internet stocks. So, you know, you felt embarrassed to say things like, well, what's the real business? People would just look at you and say, well, it's an internet business. You know, this is not a normal business. It's the internet. On the internet, old logic doesn't apply. So, you know, nonsense drove out sense, really. And common sense, you know, common sense was a major handicap. And it always is a major handicap in a speculative bubble. You know, the whole point, as long as the prices are going up and the bubble is still inflating, the wise thing to do is to, you know, stop thinking about it and just follow everybody else. It's like a game of musical chairs. As long as, you know, the music's running, you can make money, and it's perfectly rational to invest. You know, the problem is everybody thinks they're going to be smart enough to get out before the music stops, and, you know, they never are, because in the aggregate it's impossible for everybody to get out, because when everybody tries to get out at the same time, that's what a stock market crash is. So I try to explain this through the book, you know, going through individual. It's not all, as I'm explaining it, it sounds like it's all me talking, but actually most of the book is a narrative of what happened and trying to explain it. And then when I get to the end, I tried to draw some lessons. What happened was, just to finish off the narrative, things were going insane, everybody was getting rich, you know, the internet was taking over the world. And the problem was, because the stock market was dominating the economy, rather than the other way around, rather than the economy leading the stock market, Alan Greenspan, who had adopted a hands-off policy. I'm very critical of Greenspan in my book. I think he let the speculative bubble get completely out of hand. The role of the Federal Reserve hasn't always been around, after all. It was founded in 1913 after a speculative crash, really, in 1907, which nearly brought down the entire American banking system. J.P. Morgan, who was the leading financier of his day, and his friends said, look, we can't let this speculation go on. It's going to ruin us all. We have to set up we need a financial cop. There was no financial cop before. It was lawlessness. So the Federal Reserve was set up in 1913. Sorry about that. Thank you very much. The Federal Reserve was set up in 1913, and for 50 or 60 years it was taken as, you know, assumed that one of the main roles of the Federal Reserve chairman was to oversee Wall Street and to prevent this type of financial insanity from occurring. In the 1960s, William Chesney Martin, who was one of Greenspan's predecessors, maybe some of you old enough to remember him, he was chairman of the Fed for about 7 or 8 years. he defined the role of the Fed chairman as being, I can't think, the exact quote escapes me, but it was along the lines of being to remove the punch bowl before the party gets too riotous. And that's what the Fed's there for, you know. That's why Fed chairmen dress in blue pinstripe suits and why they're 60 or 70-year-old. You know, they're supposed to be conservative elder statesmen who, when everybody else is losing their head, they step in and say, look, this is crazy, guys, we need to restore sanity. Greenspan refused to do that, even though he's a very bright man, and he refused to do it for two reasons. The first reason was that he'd convinced himself that this wasn't the role of the Fed, that the role of the central bank was to look after the economy generally and to ignore Wall Street. Greenspan had been on Wall Street for 30 years, remember. He knew all about Wall Street. He knew how it could go crazy. He knew how prices could get out of hand. But so, you know, he was a Wall Street insider. He's had his own Wall Street firm for years. But he persuaded himself that his job was to look after the American economy, to look after things like unemployment, inflation, the dollar, the balance of payments. And when he looked around the country, the American economy seemed strong. It was strong. You know, we'd had this longest period of prosperity ever. He was getting a lot of praise for it. Okay, things were getting crazy on Wall Street. You know, Amazon.com was worth $30 billion. Yahoo was worth $100 billion. And that was sort of crazy. But the rest of the country seemed to be in good shape. So he said, well, I'm just going to turn my eye away from Wall Street and not do anything, you know. That was part of it. But the other part of it, he'd actually bought in intellectually to this whole idea that the internet was and information technology more generally was transforming the economy. You know, the phrase new economy came into vogue. Oh. I think some old technology not working there. Perhaps we can shine an online vision down there. But anyway, as I say, Greenspan is a very interesting man intellectually, you know, very smart man, not just a boring economist or an accountant, like a lot more interesting guy intellectually than he looks. He'd bought into this idea that the new economy was real and that productivity growth was a lot higher than it had been before, and that was a permanent thing. The American economy could grow a lot faster than it had in the past without generating inflation because information technology had changed everything. You know, he didn't talk in the same way that the internet gurus in Silicon Valley did. He talked in much more reserved and, you know, economic jargon. But it was basically the same idea that, you know, the old rules of the economy didn't work anymore. This was a new economy and we could grow not as fast as we wanted, but a lot faster than we used to do. So because of that, because he didn't take Wall Street too seriously and because he decided that the American economy was, you know, capable of what previously would have been thought as miraculous growth, he let the economy keep growing and he let the stock market keep going up. Even, you know, between November 98 and the start of 2000, the NASDAQ went from less than 2,000 to more than 5,000. That was completely unprecedented, you know, growth of like 150% in a year and a half. The Dow, I think, went from about 7,000 to 11,000. The only time we'd seen anything like that before was in the late 20s, you know, before the stock market crash of 1929. And something very similar happened then as happened now. If you let a stock market career out of control like that, eventually it's not just a stock market, it takes over the economy. People, American people, whoever, Japanese people in the 1980s, exactly the same thing happened there. They feel rich. They think, my God, this paper wealth I've got because I own 1,000 Amazon.com shares, it's real. You know, I'm richer than I was 5 years ago. They go out and spend, and the economy starts growing faster. And if you know, it's not just one person, it's millions and millions of people. Their pension plans are growing up. Their 401ks, they had $100,000 in their 401ks. They've shifted into technology. They're worth $500,000. Some of them were millionaires. My God, I'm a millionaire. I'm going to go out and buy that new SUV. So the economy sort of careered out of control, and by the end of 1999, start of 2000, it was growing at unprecedented rates. It was growing at like 7 or 8% a year. And even Greenspan and the other people, especially his colleagues on the Federal Reserve, said, look, things are just getting completely out of hand. You know, we can't let this go on forever. Inflation will be back. The dollar will collapse. We already have the biggest trade deficit in recent history. You know, the stock market's it's out of control. It's not just the stock market's out of control, the economy's out of control. We have to raise interest rates. So around Christmas, and Greenspan himself, having, as I say, been agnostic or even supportive of the new economy position and been agnostic about the stock market, decided, okay, guys, we have to do something. You know, we can't have the people were talking about. You know, a serious, well-educated journalist wrote a book, which you may have read, maybe you bought it, Dow 36,000. That came out in, I think, start of 2000, the end of 99. People were talking about 20,000 Dow, 50,000 Dow. Guy for Wired magazine was saying the Dow's going at 100,000. You know, Greenspan, okay, he's a new economy guy, but, you know, he's not lost his sanity. He realized things were getting out of hand. So they said, we have to start raising interest rates. Whenever the central bank starts raising interest rates, that's when a stock market collapses. I mean, they don't like to say it. Nobody announces it. You know, we're going to sink the stock market. But that's what happens. It happened in 1929. It happened in Japan in the late 1980s. And it happened in America at the start of 2000. You can date it pretty precisely. Greenspan started talking about raising interest rates, or the possibility of raising interest rates. I think first speech he gave, it's in the book, but it was about January 13th, I think, 2000. And he started raising rates a few weeks later. Stock market sort of wobbled and sort of went down a bit, came back a bit. People didn't want to believe that, oh my God, he's not really going to raise rates, is he? You know, the party's not over. It's like the end of any party. People say, no, the bar can't be closing. But actually it was, and he raised rates again. And the NASDAQ crashed in April 2000, you know, directly as a result of that. Greenspan would have kept raising rates until the NASDAQ did crash, or until it went down significantly. If you remember, he came out with a very convoluted set of arguments about how he wasn't really targeting the stock market, he was targeting the economy. But everybody on Wall Street knew that, of course, he was targeting the market. And, you know, the smart money started selling out, and the market collapsed. So that was the NASDAQ crash. Once it starts crashing, you know, the logic works in reverse. Everybody's trying to get out. The mob tries to get out at the same time, and anything can happen. So we went from 5,000 back down to 2,000, which is where we are now, obviously less than 2,000 on the NASDAQ, and we have a recession. So I take you through all that process in the book, or I try to, and then at the end of it, I try and draw some lessons, and I'm going on a bit longer than I wanted, but I'll just read what my conclusions are, and then if anybody has any questions. Here we are. Might be a bit difficult. Now that the dot-com era is... Can you hear me at the back still? Yeah. Now that the dot-com era is receding into history, it is easier to see what is left of it. To begin with, the internet remains a technological wonder. According to the latest estimates, more than 300 million people around the world use it to communicate in ways that would have been unthinkable a generation ago. As a research tool, mail service, and repository of human fascinations, the internet is incomparable. And I'll skip a bit and move on. The problem with the internet... Oh, sorry, here we go. I talk about how historians will look at the internet in 20, 30, 40 years. What the historians will have to say about e-commerce will be less than flattering. Most of the early claims made about the online economy turned out to be grossly exaggerated. The internet, it transpired, was not a disruptive technology that would destroy any company locked into the old ways of doing things, such as selling books in stores, printing news on paper, or using people to sell stocks. The bookstores, newspaper companies, and brokerage houses are still in business, and most of them are doing fine. In each of these industries, old economy firms, far from being displaced by the internet, have used it to get closer to their customers. BarnesandNoble.com allows people to return unwanted books to Barnes & Noble bookstores and continues to take market share from Amazon.com. I apologize for the plug for Barnes & Noble. I didn't realize they'd be giving me a thing. Anyway, the online edition of the Wall Street Journal boasts about 500,000 subscribers, most of whom also buy the print edition. Merrill Lynch offers online trades for $29.95, but the majority of its clients also use the firm's human brokers, who are much more expensive. These clicks and mortar strategies, as they've been dubbed, work because they treat the internet as an important and unique distribution channel, which it is, but they don't rely on it to the exclusion of all else. In fact, it's difficult to think of a single example in which an internet company has completely supplanted a major old economy firm. Most internet startups failed because they were based on the mistaken premise that the internet itself represented a revolutionary new business model, which it didn't. It wasn't a business model. It was a tool that companies can use to build their businesses if they can combine it with distinctive products and at the same time avoid ruinous price wars. But it's nothing more than that. The internet companies that will survive will be those providing services that wouldn't otherwise exist, such as eBay, and those providing services that complement existing products, such as Travelocity.com. It is no accident that eBay and Travelocity.com deal in information goods. The internet's great strength is its capacity to process information. Any good that can be standardized and converted into ones and zeros has the potential to support online commerce. When the legal issues surrounding copyright are finally resolved, this category of goods will include music. When the money is finally found to make broadband connections the norm rather than the exception, it will also include films. Some things it won't include, however, are groceries, pet food, and furniture. People still prefer to buy most goods in a store where they can look at them, pick them up, and try them out. In the year 2000, online purchases came to less than 1% of total retail sales. In the publishing industry, where online stores were well established, only 1 book in 15 was being bought online. The presence of so many people in a supposedly doomed bookstore, I think, speaks volumes. The main reason that internet retailing has been such a financial disappointment is that it is in fact more about retailing than it is about the internet. Any retailer is basically a distributor, purchasing goods from the manufacturer at wholesale prices and getting them into the customer's hands at retail prices. Whether the goods are delivered to the nearest shopping mall, as in regular retailing, as in the case here, or to the doorstep, as in the case of online retailers, is a secondary matter. Either way, building a distribution system is a very costly and arduous operation. Whereas a state-of-the-art retail website might cost about $25 million a year to develop and maintain, a nationwide system of warehouses and delivery trucks, such as the one that Amazon built and Webvan tried to build, well, they did build it, but it didn't last very long, can cost $1 billion to construct and another $200 million a year to operate. The savings that Amazon.com enjoyed by not having any stores turned out to be largely eaten up by the extra costs of packing, shipping, and especially promotion. Because online firms don't have a retail presence in the street which people walk past, they have to spend a lot more on advertising to remind customers of their existence. Competitive pressures also make the internet a very tough place to do business. In the debate about whether online commerce would most resemble the economic model of perfect competition, or the economic model of winner takes all, with which there'd just be just a few suppliers, the supporters of Adam Smith have come out on top. Barriers to entry on the internet remain low, and being the first mover is no guarantee of success. Pets.com and eToys both had plenty of name recognition, but they still went bankrupt. As even more of the bubble companies go out of business, the intensity of competition on the internet will diminish, but profits will still be hard to find. The fundamental lesson of a speculative bubble, I'm jumping ahead just to the final conclusion, the fundamental behavior of a speculative bubble, such as the one we've lived through, is that behavior that seems rational at the individual level can lead to collective insanity. Trapped in the logic of herd behavior, Wall Street will inevitably keep inflating the bubble until it bursts. It is up to journalists and government officials to try to maintain a degree of sanity, but in this case, neither one of them proved up to the task. Despite some honourable exceptions, the overall standard of reporting on the internet stock phenomenon was dismal. In many cases, CNBC being the only the most obvious example, the media became an active participant in the bubble, turning entrepreneurs like Jeff Bezos into celebrities and parroting the Wall Street line on stocks like Yahoo and Amazon.com. Economics was largely responsible for this deterioration. The internet boom created a vast new source of advertising which newspapers, magazines and television networks rushed to exploit. Some journalists genuinely believed in the internet, others were reluctant convert. Either way, the result was the same: more hot air pumped into the bubble. I then have a section about Greenspan, but I've sort of covered him. Silicon Valley, Wall Street, the media, and the Fed all played roles in the internet bubble. But when all is said and done, it was primarily a story of greed and gullibility on the part of the American public itself. And not just the American public, there were internet bubbles in Europe and Britain, where I'm from, and Japan as well. I'm not trying to pretend this is a purely American phenomenon. H.L. Mencken once wrote, back in the 1920s, when he was the most famous journalist in the country, "The notion that Americans are a sordid, money-grubbing people with no thought above the dollar is a favourite delusion of continentals, and even the English on occasion dally with it. In fact, it has little solid basis. The truth is that Americans as a race set relatively little store by money. Surely all their bitterest critics are at least as eager for it." Had he lived through the 1990s, Mencken might have changed his views somewhat. At the height of the boom, the United States was consumed by the idea of getting rich on the internet. College students, cab drivers, construction workers, dentists, doctors, journalists, congressmen, even Hollywood stars, they were all buying and selling internet stocks. Just as a little aside, one of the people who features prominently in this book is Mary Meeker, who is the internet stock analyst at Morgan Stanley. She turned into such a celebrity during the internet boom that she literally had Barbara Streisand calling her up for investment advice. And she wasn't the only one either. The internet economy was an American creation dominated by American firms, people with instantly recognizable American types. While it is true that internet stocks eventually spread to Britain, Germany and Japan, the internet mania in those countries was nowhere near as intense as it was in the United States, and for good reason. It was because of these instantly recognizable American story types. There was Mark Andreessen, the gawky farm boy from Indiana who founded Netscape. Jerry Yang, the hard-working Asian immigrant who founded Yahoo. Jeff Bezos, the clever high school valedictorian who founded Amazon.com. Henry Blodgett, the smooth-talking New England preppy who was a famous internet analyst at Merrill Lynch. Jim Cramer, the fast-talking Jewish kid who made a fortune in the stock market and set up his own internet company, CNBC. Jim Clark, the crusty Silicon Valley engineer who financed Netscape. With this cast of characters, the internet boom and bust was like an epic mini-series that grabbed the imagination of the country and held it wrapped until the final episode had ended. But unlike the case of a television program, the viewers were not mere passive couch potatoes. By quitting their jobs and joining an internet startup, or simply by buying a few hundred shares in Yahoo or one of the other internet companies, they could become actors in the ongoing drama that was consuming the country. The desire not to feel left out fuels all mass movements, and the internet bubble was no exception. Coupled with greed, the desire to not feel left out is virtually irresistible. By the end of the internet boom, there were few Americans left who were able to resist it. So that's my message, such as it is. I'd be happy to take questions from anybody who has them. Sorry.
If someone has a question, you can wait until C-SPAN moves the boom mic near you so we can get the question as well. We'd appreciate it. Thank you.
Yeah, sure.
This really doesn't have much to do with the internet as a technology, but more from your perspective on Wall Street as a journalist. Do you think, given our current situation, that the powers that be are going to go into another boom anytime soon?
Sorry, the powers that be that what?
Are going to go into an economic boom anytime soon.
Is there going to be another economic boom, a stock market boom or a broader economic boom, or both? Both, right?
Both.
Yeah. I think I don't think it's possible that we're going to see another internet bubble in the next 10 or 20 years. I mean, people are stupid, but they're not that stupid. And it takes...
use tulips.
No, I don't think so. You only get one speculative bubble per generation, usually. It takes, if you look back through history, they generally occur every 30 or 40 years. There was one in the 1920s, there was another mini one in the late 50s, early 60s, and then there was one in the 90s. And I think there's a good reason for that. It's because you have to wait for most of the people who are involved to die. And, a new generation to grow up who've forgotten what a speculative bubble is like. So... Sure, there may be I'm not saying there won't be mini speculative manias, there may be. There could easily be a biotechnology bubble or something, or, if somebody invents a gene which keeps you alive forever, I'm sure, Wall Street will patent that, and that stock will probably trade at 5 million times earnings. But I don't think there's going to be a society-wide speculative boom like this for the foreseeable future. So, sorry.
The thing that I'd always thought about the situation was it's kind of analogous to what happened, excuse me, in Albania. You remember the basically crooked scheme that
right.
half the company invested in? and then the other half got jealous and they invested in it too, and then the crooks disappeared, including the president.
Right.
And then they went out and they took all the armories out.
Yeah.
And they basically went hysterical on a rampage.
Well, I mean, the Albanian scheme, I don't profess to be an expert on the Albanian economy, but as I understood it, it was basically a pyramid scheme, which was more like the Florida, pyramid schemes in the 1920s. Now, the internet boom did certainly involve elements of a pyramid scheme. The people who got in early, they made most of the money, and the people who came in late, they lost most of the money.
Yes, and you noticed, too, when you were talking, that the reason eventually that people that should have had more sense got involved is they were jealous of the people who they saw making money.
No, I mean, jealousy is a very potent force,
Same thing happened in Albania.
Sure. But I mean, but Albania, Albania was open criminality. I don't think there was much actual... I don't think there was much criminality in the internet boom. I mean, there was a story of human fallibility, and there was some sharp practices. I mean, the book is called .con, and, I think there was an element of conning going on. Wall Street wasn't perfectly open about these companies and was misleading to some extent their finances. Certainly the Wall Street analysts were not objective. Most of them were making money from bringing these companies public. So I think that's all true. But the Albanian scheme was a straightforward, as I say, as far as I understand it, and certainly the Florida real estate, it was a straightforward pyramid scheme. It was a Ponzi scheme. I mean, the phrase Ponzi scheme comes from Florida.
Yes. It wasn't prosecutably illegal
Right.
what happened with the internet, but when you look at the other things that happened in the American economy,
Right.
like
Enron, you mean?
Enron, and look back 5 or 10 years, what happened with all the savings and loans.
No, sure, I'm not saying there's not crooks in the American economy. I mean, obviously there are. I mean,
Regulated, they come out of the woodwork.
the entire board of Enron look as they're in trouble. Sorry, yeah.
I wanted to know, how much of the blame do you think the media should take responsibility for dousing the lighter fluid on an e-commerce flame?
It's a good question. I think the internet. I mean, I think the media played a big role in the bubble. Most Americans get their information from the media, obviously, and have 2 or 3 chapters in the book talking about how the media helped pump up the boom. And I think there's a couple of explanations for it. Firstly, which I've already mentioned, is that there was a big financial incentive for the newspapers and magazines and television stations to pump up the bubble, because most of the money that was raised on Wall Street and the internet ended up being spent on advertising. So the money went straight from Wall Street to the media companies in a lot of cases. So that gives you a big incentive to say good things about the internet. But I don't think it was just that. That was certainly part of it. Papers, even serious papers like the Wall Street Journal and the New York Times, were publishing technology supplements, stuff full of technology advertising. The New Yorker, the magazine I work for, even we were publishing occasional technology issues. And, a lot of that was financially driven. And, that doesn't lend itself to objective reporting, it's true. But I don't think it was just corruption. I think a lot of journalists I know, because I know a lot of them personally, really fell for the whole internet equals, a brave new world idea. And the other thing was, the bubble was... The internet is an information good. I mean, an information technology. So suddenly this speculation was taking place in the journalistic world. You weren't just a journalist anymore. You were a content provider and a potential, internet web billionaire if you could set up your own company. Lots of journalists in New York and in other places left journalism to become internet billionaires, they hoped. So that definitely separates it from previous bubbles. Because you think of a gold rush, very few journalists, go and dig rocks, so they're not involved in the gold rush. They weren't involved in the biotechnology bubble, but this gave them a chance to become involved. So I think, your point is right. The media has a lot of responsibility.
You stated that it's the responsibility of the media to inform the people of such speculative behavior, and when something like this happens, when the analysts on those MSNBC shows are linked to the very companies that brings these IPOs to the market, then it becomes a catch-22 situation.
I don't know. It's catch-22. It's certainly a bad situation for the public when they're watching MSNBC and the people who are pumping the stocks are pretending to be objective. And I have a chapter criticising NBC's role. I think they were particularly culpable in all this, and it's true, but. So I do think that, as I say, the media was not totally to blame, but as I said earlier, they were one of the 4 legs on the stool. So they But the American people themselves, and not just, as I say, other nationalities, must bear responsibility as well. You shouldn't believe what your stockbroker tells you. You shouldn't always believe, what you see on CNBC. You bear some responsibility yourself to go out and check out these companies. And most investors didn't do that, They just followed the crowd. So.
You said you are not expecting a speculative bubble in the near future again. But what about the usage, the internet, the technology? Do you think you think it will just be sort of hanging around? Perhaps more e-business stuff or books sold or?
I mean, it's a big question. The book is not meant to be an attack on the internet as a technology. I think internet usage will continue to grow, not as rapidly as it has in the US. Because in the US and the UK and Japan, we're sort of reaching saturation levels. Most people who want to go on the internet are already connected. But it will keep growing, and it'll especially keep growing, in other less developed countries where the penetration rates are much lower. So I think the internet, is going to be, as it already is, an amazing technology and amazing innovation, which has changed the world in ways which we never could have thought possible 20 years ago. But that doesn't mean that it repealed the laws of economics and the laws of business. They're still in existence. And the other thing which I think is happening, and you see that throughout the economy, is you're seeing a convergence between the old economy and the new economy, which I guess the classic example of that is the merger between Time Warner and AOL. A lot of these companies are not. Is AOL Time Warner an old economy company or is it a new economy company? Well, it's both. And I think you're going to see more and more of that. I wouldn't be surprised if, some Disney or News Corporation or somebody buys Yahoo, for example. Amazon.com even could easily be taken over by Walmart or Kroger or somebody. So I think the internet's important, but I think it's becoming part of the regular economy. Anybody else? Sorry.
One of the things I remember is, I think it was about a year before the bubble, Gartner came out with they did a story. They said 98% of the internet companies will die with a 80%, probability. Right. How much of an influence did that have on the eventual time?
Well, no, I mean, it's true. There were warnings at the time, that a lot of these companies would fail. But the problem is, nobody listened to them. There were some skeptics out there. And even some of the leading internet analysts were, Mary Meeker and people were saying that a lot of these companies will fail and that only 2 or 3 in each sector will succeed. But when the stock market, the problem was the stock market wasn't discriminating. For a while everything was going up. And when investors saw everything going up, they bought everything. So it wasn't so much, a problem of analysis in this case. It was the bubble itself produced incentives to do crazy things, and people, they fell for the bubble. That was it. Anybody else? Yeah.
What's your opinion about? If somebody has to do business tomorrow.
Somebody has to do business tomorrow
using internet technology. It has to be click and mortar.
Yeah, I think click and mortar is the wave of the future. As I say, I think I'm not saying there won't be any standalone internet companies. I think if you want to launch an internet company, what you have to ask yourself is, A, do we provide any service which people can't get in any other way? There are some great internet companies. eBay is a phenomenal company because they provide a service which you can't get anywhere else. And they have a very low cost structure because you have to pack the goods and send them yourself. They don't get involved. They are a real virtual company. They're an online company, unlike Amazon, which is partly online, but then has to employ people to, pack the books and ship them, etc. And is also competing with these guys and lots of other people. So I think if I was an internet entrepreneur, which I'm not, but if I was thinking of financing a company, I'd look at it and I'd ask a couple of questions. I'd say, how does this exploit the internet technology? Is it really an internet company, or is it just, partly an internet company? And then I'd ask some business questions like, well, where's the revenue stream? Do we supply a good which people are willing to pay money for? And in a lot of cases, the answer was no. But even that's not enough. You need to ask yourself, well, do we have any competitive advantage here, or are 10 other guys going to launch a website which competes with it as soon as we're up and running if we seem to have any chance of success? Because from an economics perspective, the problem with the internet is, or one of the big problems from a business perspective rather, is that, as I said, the barriers to entry are so low. So if anybody looks like they've got a good idea, 20 other people are going to do the same thing because there's nothing to stop them launching a website. So you need to ask yourself, you know, as I say, do we exploit the technology? Have we got a revenue stream? And are we going to be swamped with competition? And if the answers to all those questions are favourable, then, you know, sure, go ahead. But the problem is there haven't been so far many businesses which have shown to have, you know, to answer all those questions. You know, sure.
Opinion about many people say that e-commerce is still in its infancy. What's your?
Well, it is in its infancy, as I say. I don't argue with that. You know, online sales are still going up, although the growth is not as rapid as it was. But what I was saying, as I said earlier, this convergence, I think online commerce is just going to be, you know, it's just going to be another way of buying things. I mean, what we're seeing really is Amazon and companies like that, they're really mail order companies, but instead of using the mail service to order them or a telephone, you use the internet. So I think, you know, online commerce will continue growing, but the companies, they'll just have, it'll be just one distribution vehicle that they use together with, an old-fashioned one. You're seeing that in the media sector. I think you're going to see it increasingly in the retail sector. It's already happening in Europe in various places. In England, for example, where I'm from, if you want to order food, lots of the supermarkets, here online companies like Webvan and HomeGrocer.com tried to launch online groceries. In the UK, lots of people order groceries online, but they do it from Safeway or the Sainsbury's or the big supermarket chains. And that's, again, a clicks and mortar strategy. So that is e-commerce, but, the company which benefits from the e-commerce is an old economy company. Yeah. Sorry.
Last question, John, and then we'll let people talk to you while you autograph them.
Okay, well, just two.
Okay.
You go.
What if Mr. Greenspan had not intervened when he did? What
Dow
if he
20,000, 30,000?
Perhaps.
No. If at some stage the bubble would have burst of its own accord. I mean, it was showing strains already in early 2000. Greenspan, I think, just hastened the collapse. I mean, it couldn't really have gone up indefinitely, I don't think, because, as I said, it's all a matter of crowd psychology. And crowds, if you think of them, they tend to stampede in one direction for a long time. If you think of a herd of wildebeest, for example, I hate to compare people to wildebeest, but in this example, they did behave rather like them. They tend to stampede in one direction for a long while, but eventually, I think they would have turned and stampeded in the other direction. Obviously, I don't know how long it would have lasted. So maybe we'd still be going now, but if it was, we'd be waiting. We'd be just lining up another enormous crash.
Mine's two-part. I don't understand how a situation like first question is, how is it that if by raising the interest rates, does that actually lower one thing? I don't understand that part. And the other thing is, how is it like Webvan or before them there was a company called Peapod?
Peapod, yeah.
Yeah. And I mean, I hate going to the grocery store.
Right. Why didn't they work?
I don't care about touching an apple or, if I have to stand in line for any more than 2 minutes, how is it that companies like that didn't last?
Didn't work, okay. First question about the Federal Reserve and how interest rates sink the stock market, affect the stock market. It's a complicated economic question, but basically, when the Fed's raising interest rates, they make the cost of borrowing more expensive, obviously. That slows down the economy, reduces demand in the economy, and will eventually, if they keep doing it, bring on a recession. Investors, stock market is basically a vote about the future. The stock market doesn't look backwards, it looks forward. So they look at the future, they see the Fed raising interest rates, they think a recession is on the cards, maybe it won't be for a while, but it's coming, the Fed will keep raising interest rates until there is a recession. And profits, in a recession, profits collapse, especially speculative. Well, there weren't any profits in the internet sector, but the prospect of profits, recedes into the past, and stock prices fall. So people on Wall Street all understand that, and it's become sort of automatic. They don't even need to go through the logic it's ingrained into the minds of the analysts on Wall Street that when interest rates go up, the stock market will start falling. So what you get is, in anticipation, once the market even senses that interest rates are going to go up, the Fed's going to cut interest rates, the market goes up. And the reverse is also true. When the market senses that the Fed might start cutting rates, the market goes up. And that's what we've had in the last year or so. Stock market's been going up in anticipation of the Fed cutting rates, which is now done. Now that the Fed stopped cutting rates, the stock market has, leveled off, and it's not clear where it'll go. So it is complicated, but it's a pretty firm link. Why didn't Webvan work? Why didn't homegrocer.com work? Because not enough people, well, various things. Webvan, for one thing, it was very, very costly to set up a national distribution system. You are ordering fresh fish online, they have to get it to you in a few hours or it's going to go off. It costs a lot of money, and not enough people were willing to pay a premium to do it. That was basically it. So they set up this enormous distribution system. They built a big warehouse in Oakland. And, it was a fantastic service. You could, as you say, I agree with you. It was nice to sit at home and order food for nothing to be delivered. But the only way they could conceivably make money was if vast numbers of people did it, and, they got sort of economies of scale. And not enough people did it, so they had high costs, low revenues, and they went broke before they got enough customers. So that's it. Anyway, guys, I think that's all we have time for. Thanks very much indeed for coming. And if you'd like to buy the book, I'm happy to sign it. And again, I hope you enjoy the Olympics.